By 1999, the financial world had lost its mind. Companies with zero revenue and zero products were buying multi-million-dollar Super Bowl commercials. One ad literally just asked viewers to please clap because their website was launching in March. And the crowd did. People were throwing their life savings at companies they didn't understand. This era of irrational exuberance wiped out nearly $5 trillion and crushed thousands of startups, but it also funded a massive premature expansion of the fiber optic networks and server farms we rely on today. To understand how a mistake of that scale happens, we have to go back to 1995. The early internet was a slow, screeching, painfully glitchy place. You had to tie up your home phone line and wait 10 minutes just to download a pixelated picture of a cat in sunglasses. But despite the awful user experience, a total consensus had formed. This glowing, mysterious network would dictate the future of human commerce. The problem was, nobody actually knew what a digital business was supposed to look like. That technological vacuum created a dangerous void on Wall Street. Because venture capitalists couldn't comprehend the mechanics of the internet, they simply threw out traditional financial metrics. They stopped asking about profits and started funding pure hype. Suddenly, all you needed was a terrible idea and a pitch deck. A startup called ToiletSeatTracker.com raised millions of dollars just by promising to use AI to predict when public restrooms would be vacant. To see how broken the system was, look at this chart of a typical dot-com business model. On the right is their actual revenue, a tiny sliver. On the left is their burn rate, the towering column of venture capital they were spending to acquire eyeballs. Because they were selling products at a loss, that cash column evaporates almost instantly. To keep the lights on, the company required a continuous, even more massive injection of outside cash month after month. By March 10, 2000, this cycle of hype pushed the Nasdaq to an all-time high of 5,048. Retail investors day traded from bedrooms. Dentists bought tech stocks between cleanings. Everyone felt absolutely invincible. The entire financial ecosystem believed it was building a permanent new economy. They completely missed the stark reality that the underlying businesses they were trading were actively bleeding to death. The euphoria stopped the moment someone finally asked a basic question: wait, how much money are you actually making? When a few massive tech startups missed their earnings targets, the mood in Silicon Valley shifted from invincibility to absolute panic. The ensuing sell-off was brutal. Over the next 2 years, the Nasdaq plunged 78%. $1.7 trillion in market value simply evaporated into thin air. More than half of all internet companies went bankrupt. Sprawling headquarters were abruptly abandoned. Thousands of engineers packed up their desks, and expensive ergonomic office furniture ended up stacked in liquidator warehouses. Even the companies with actual customers faced near-death experiences. Amazon, a company that was successfully shipping physical goods across the country, watched 95% of its stock value disappear. The crash shattered the public's belief in the internet. College students dropped their computer science majors, and the media rebranded the technological revolution as a massive, embarrassing scam. But while the loudest companies were burning to the ground, a small handful of engineers missed the memo that the party was over. They stayed in their offices and kept writing code. Jeff Bezos refused to panic. Instead of chasing new trends, he shut down unprofitable side ventures and slashed internal costs. He bet everything on logistical execution, ensuring that if a customer ordered a book, it arrived faster and cheaper than anywhere else. Meanwhile, Larry Page and Sergey Brin weren't buying Super Bowl ads. They were sitting in a garage, quietly refining search algorithms for a text-based website called Google. The survivors shared a remarkably boring strategy. They prioritized profitability. They solved actual problems, proved that consumers wanted their product, and secured real cash flow before they ever attempted to scale. The crash acted as a filter. It purged the businesses built on vibes and left behind the engineers who focused on unit economics. But there was another hidden legacy of the 1999 frenzy. The billions of venture capital dollars spent by failed startups didn't just disappear. Much of it was spent on the hardware required to keep those businesses online. To meet the projected bandwidth needs of thousands of new dot-coms, infrastructure firms laid thousands of miles of fiber optic cable and built massive data centers. When the startups went bankrupt, They left behind a skeleton of high-capacity hardware. When the next generation of founders started building Facebook and YouTube a few years later, they didn't have to spend billions laying the physical groundwork. They simply built on top of the discounted infrastructure their predecessors left behind. This newly robust network sat waiting until 2007 when Steve Jobs stepped onto a stage and held up a small device that turned the internet from something you accessed on a desk into something you lived inside. The dot-com crash was a violent, accidentally crowd-funded infrastructure project. It left the next generation with a surplus of connectivity that eventually turned the internet from a niche utility into the primary setting for modern life.